CRAMS player Syngene International not only reported a steady set of numbers, but also guided for healthy underlying growth outlook. While it continues to be in investment phase, expanded scope of engagement with the likes of Bristol Myers Squibb, Baxter, Amgen and Zoetis adds to earnings visibility. Syngene posted 8.5% year-on-year growth in top line with steady contributions from all segments, dedicated R&D centers, drug discovery services and development and manufacturing services. In discovery services, the company conducts early-stage research for further development, while development services focuses on preclinical to clinical trials and the safety and efficacy of the selected drug candidates. Last year in the same quarter, the company witnessed strong contribution from the sale of remdesivir, which was in huge demand because of the Delta wave. In Q1 FY23, there was no sales recorded for remdesivir. Excluding the impact of remdesivir, the underlying revenue from sales growth was 30%. Gross margins improved to 75% versus 67% in Q1 FY22 as remdesivir had a lower product spread. Raw material used for remdesivir was non-inventorized, or rather had to be bought at spot levels. EBITDA margins excluding forex impact were up to 24 basis points year-on-year, wherein gross margin improvements were offset by higher power and fuel and other expenses. Furthermore, due to forex hedge loss, higher depreciation and higher tax, the net profit declined by 4% YOY. Key highlight of the quarter was the 10-year manufacturing deal with Zoetis. The company had earlier worked with Zoetis on various other business functions of CRAMS, but this is the first large-scale manufacturing contract with the company. Syngene would manufacture drug substance for Librela subject to regulatory approvals. The agreement, initially centered on Librela, paves the way for the development and manufacturing of other molecules in the coming years and is expected to be worth up to $500 million over next 10 years. Other than this, Syngene continues to invest in manufacturing capabilities for biologics. This will help in the production of a wide variety of biologics drugs, ranging from anti-cancer to hormonal disorder therapies. So far, around 10% of the cumulative investment is in biologics, which makes it an investment of $50 million. Another $30 million spending is budgeted for FY23. The company expects 1x asset turnover for these manufacturing businesses over a period of about 5 years from investment. While EBITDA margins for biologics depend on the complexity of process and raw material component, management expects it to be in line with overall Syngene margins as capacity utilization increases. Syngene has upgraded its FY23 revenue guidance to high teens from mid-teens to account for rupee depreciation and the multi-year contract for Zoetis, which is expected to start by the end of this fiscal year. EBITDA margins are expected to remain around 30% despite volatile raw material trend and elevated other expenses. As the company completely hedges for next 1-year contracts, forex impact would not be visible in the bottom line. Now, despite a healthy top line, profit growth is expected to be in single digit only as incrementally higher depreciation and taxation kick in. Higher depreciation is likely due to commissioning of new facilities and higher taxation as earlier tax benefits are getting lapsed gradually. Having said that, Syngene's investment phase continues with a capex guidance of $100 million. Of this, about $30 million would flow to biologics and $50 million to research. As per our calculation, at optimum utilization, Zoetis contract and investment in biologics can translate into 1350 crore revenue, which is nearly 50% of FY22 revenue. Among the leading projects as part of the Phase 3 expansion in Hyderabad, a lab has been commissioned with over 150 scientists and analysts dedicated to PROTACs, a targeted protein degradation technology that offers therapeutic intervention not achievable with existing drug discovery approaches. PROTAC is part of Syngene's novel drug discovery strategy for clients involved in the treatment of cancer. Now coming to API manufacturing plant at Mangalore, the company awaits key regulatory approvals here. The US FDA approval is expected in the second half of FY24. Overall, we are positive on the underlying revenue growth, which is expected to be 20% plus in the medium term. Bottom line is also expected to improve from FY24 as operating leverage kicks in. Over the years, global innovators have been scouting for research partners to expand their product pipelines, curtail R&D costs and offset the impact of impending patent cliff. Moreover, small-sized innovator biotech firms which lack capital or skilled resources tend to outsource a substantial part of their R&D. Syngene appears very well placed to capture this trend. A risk to watch is execution in the field biologics and pending regulatory approvals. While valuations at 22x EV to EBITDA for FY20 for estimated earnings are pricey, strong cash flow, balance sheet and order book visibility suggest that premium is likely to sustain. And in this context, we believe one should accumulate the stock during market-wide corrections for the long haul.